Kia ora and daja hao, and thank you for your comments, Ambassador Yeung, and greetings, Mayor Browne. I've been looking forward to this session, but before I do set it up, let me introduce our two guest speakers. First of all, Andy Browne. So, as we've already heard from Foran, Andy has spoken to us before by VC. He leads the Brunswick China Hub, and he advises clients on China-related issues. Prior to Brunswick, Andy ran the editorial program at Bloomberg New Economy Forum, a platform set up by Michael Bloomberg, and that was done to connect CEOs and government leaders from emerging and developed economies. He's spent 35 years working in Asia, latterly as the China editor and columnist for the Wall Street Journal, and he is a Pulitzer Prize winner. Then Raymond Yeung, he's the chief economist for Greater China, Australia and New Zealand Banking Group. And he leads ANZ's China's research team in Hong Kong and Shanghai. Raymond's research covers China-US economic relations extensively and the effect on interest rate and currency markets. He predicted China's stimulus package in September 2024 before its launch, and anticipated the US's massive reduction on China tariffs ahead of those weekend talks some months ago. He's consulted for China's State Council, central banks, multinational corporations. He frequently shares his insights on Bloomberg, CNBC, and other outlets. So let's welcome, please, Andrew and Raymond to the stage. Now to the session that we're going to get underway, and I begin with the word uncertainty, and I note that actually on the front of the lecterns we've got the term seizing opportunities and global uncertainties. And I think I use that word because maybe today, certainly for me, it's a word that captures the world as we see it. Certainly as uncertain as I have ever seen it. And maybe just for a minute, it's worthwhile sort of reflecting on what it was like 30 years ago. We've heard a couple of times today references to history. If we go back 30 years, actually, it's about the time that Bill Clinton became the President of the United States. And, it's always difficult summarising leaders in a short time, but maybe here was a leader in terms of Bill Clinton, bit of benevolence as a leader, guiding global process, promoting democracy and freeing up markets, engaging multilaterally, multiple countries, multiple organisations, and a term globalisation possibly comes to mind. Around the same time, it was actually a time that Deng Xiaoping was completing his reign. Once again, really difficult to sum people up quickly, but if you had to go, strategic patience, developing quietly and responsibly. Global fairness, actually sort of moving away from a term around superpowers. Sovereign diversity, non-interference, and then finally, building an economic foundation, modernisation at home. Bit of globalisation there as well. 30 years ago, time goes quickly, particularly for some of us in the room. So back to today's session and that word uncertainty, and I think it's terrific that we're going to have Andy and Raymond unpack what it looks like now, 30 years later, particularly with the US and China. Because I think today maybe the terms sort of simmering and fragile come to mind. And I'm interested to hear their perspective on it, as I'm sure you are. And then we can unpack how some of that may ripple out to us here in New Zealand. Do you want to go first, Andy?
Sure. Well, thanks, Greg, for that introduction. Real honor to be here. 早上好，你好，王大使。And thank you to Foran for inviting me, and Greg, you and New Zealand for flying me out here in such great style. So, while I was in the air on my way to Auckland, Bloomberg News, my old shop, one of my old shops, ran an interview with Mahathir Mohamad, the former Prime Minister of Malaysia, who's just turned 100 and is still going strong. And true to form, he took a big swing at the United States and tariffs, and he declared that Trump was, quote unquote, against the whole world. The interviewer, being a proper journalist, pushed back gently and said she thought it was a bit rich coming from the leader of a country that had made its way in the world through protectionism, through tariffs and quotas. But I guess when you're 100, you can get away with this sort of thing. But he made a pretty important point, that in his first term, it was all about China. Okay, he tweaked the North American Free Trade Agreement. He added to the free trade agreement with South Korea. There was a modestly serious trade agreement with Japan, but mainly it was about China. China, China, China. They're raping us. When they're not ripping us off, they're laughing at us. They think we're all losers over here because of the trade deficit, which, by the way, continues to expand. It has to be acknowledged that in the United States, there is a bipartisan consensus that Trump, in his first term, got China about right. That when it came to China, his instincts were pretty astute. And indeed, it was Trump, and Greg, I appreciate your sweep of history, because I think it's important to put this relationship within a historical context. It was Trump who drew a line under an era of US engagement with China, and he fundamentally redefined this relationship as being competitive. Joe Biden inherited the whole lot, all of the tariffs, and added to them, all of the sanctions, all of the export controls, and added to those too. Nevertheless, as an aside, when he came in as president for his second term, because he had focused so much on China, average tariffs in the US were about 2.5% globally. They're now at 13.5%, and if everything that's on the table actually gets implemented, it's going to go up to about 20%, which is going to be the highest rate of tariffs since the 1930s, Smoot-Hawley, which of course exacerbated and deepened the Great Recession. Trump has made the fundamental, cardinal mistake in his second term of underestimating China. Biden, like it or not, whether you agree with what he did or not, had the measure of China. So for instance, when he wanted to put export controls on chip-making equipment, he worked very hard with his team worked very hard with governments in the Netherlands and in Japan. The United States aspires to be a player in the Arctic, hottest new area of global trade, believe it or not. Ice cap is melting. America doesn't build icebreakers. The Finns do, the Danes do, the Norwegians do, and so he works with those countries to get icebreakers. China does, Russia does. At one point in the Biden administration, he decided to get rid of all of the cranes in all of the ports in the United States because they're made in China. And the fear was that China would be counting things in and out, including military equipment. Unfortunately for the United States, they don't make cranes anymore. The Japanese do. And so he put in place a technology transfer agreement with Japan. But Biden got the measure of China. He understood the challenge. Ambassador Wang rather modestly declares that China is a leading manufacturing hub. I'm sorry, but that radically underestimates China's position in global manufacturing. The United States is the world's financial superpower. China is the world's manufacturing superpower with an industrial base, believe it or not, that is the United States plus Germany plus Japan plus South Korea and then some. And that gives China a critical advantage in all of the technologies that are coming, powerful technologies that are all coming of age at the same time, all of the ones that Ambassador Wang mentioned in his speech, from AI to robotics to quantum and so on and so forth. Scott Bessent, incredibly sophisticated investor, he's the US Treasury Secretary, he too underestimated China. He said, look, when China exports 5 times as much to the United States as we export to them, we have all the cards, okay? And he said the Chinese are playing with a pair of twos. It turned out, when they flipped the cards over, that China had a couple of aces. And one of those aces was rare earths. And China threatened to choke off the supply of rare earths to the United States. And in doing so, would have closed down vast swaths of US manufacturing, defense industries, the entire car industry, and the United States attempted to retaliate, denying China exports of jet engines, therefore threatening to close down China's civilian airliner project, choking off supplies of ethane and the feedstock for ethylene and plastics manufacturing. And the tariff war morphed into a supply chain war, which was far, far more serious and consequential. And finally, it turns out that China had played the United States, and they caved, completely caved, backed down, brought the tariffs. Trump brought the tariffs down from 145% to 30%, still incredibly high, but nevertheless, no longer prohibitive. That's where we are now. We have a truce. What happens next? I think the other thing that is important to note is that Xi Jinping thinks he is winning, and he may not be wrong. Yeah, there are problems in the Chinese economy. Raymond is going to be much more articulate on that than I am. We're in the 3rd year of a real estate meltdown. It's cratering the savings of the Chinese urban middle classes. Youth unemployment is high. It is crushing the dreams of an entire generation of Chinese college graduates and their families, one-child families. But Xi Jinping, of course, is enormously concerned about all this, but he's focused on a different prize, and that is the prize of technology, developing high-tech manufacturing to enable China to escape so-called American chokeholds and dominate the industries that we've just talked about. He sees what he calls changes unseen in a century, meaning the rise of China and the relative decline of the United States. This, from Xi Jinping's perspective, is China's moment to seize. Trump, to conclude, is very keen for a summit. It's the way he likes to operate, person to person. He's rather enamored of authoritarian leaders. Putin in Europe, Xi Jinping in China. He admiringly called Xi Jinping in his first term the emperor of China. He wants to go and meet the emperor. And to get it, he's prepared to give quite a lot away. I think the news just 48 hours ago, 72 hours ago, that NVIDIA, Jensen Huang got to him. And he often listens to the last person in his ear. And persuaded Trump to allow exports to China of H20 chips to power Chinese AI models. That is a big deal because they were imposed as a matter of national security, and he's now giving up national security. Now the question is, if he's ready to give that up, what else might he give up? It at least opens up a lot of room for negotiation now between the US and China. Incidentally, it makes it much, much more difficult for the United States now to get governments like the Netherlands and Japan on board with sanctions, or indeed to persuade Japan, or countries like Vietnam or Indonesia to curb their trade with China. Why would they want to offend China if Trump is going to pull the rug on them? Finally, I would just say I am skeptical, very skeptical, that there is such a thing as a US-China grand bargain. I think the relationship is defined by a core tension. At a high level, there is a almost complete absence of trust between these two countries that basically they think the worst of each other. China thinks that the United States wants to kill its economy, overthrow the socialist system that we heard about, the Communist Party. For its part, the United States is convinced that China wants to expel the US from the Asia-Pacific, take over, become the global hegemon. But, these two economies are deeply enmeshed. They are joined at the hip. And it creates all kinds of mind-bending paradoxes that, the Chinese hypersonic carrier killer missile cannot find its target without high-end chips manufactured by TSMC in Taiwan using US technology. By the same token, the American Patriot missile cannot defend against Chinese rockets without magnets, rare earth magnets that come from China. This is a relationship that we can describe as being weaponized interdependency. I think the final game here is probably going to look like what it was in the first Trump administration, which is a rather thin purchase agreement, and I think we're going to be hearing a lot about fentanyl and a crackdown on fentanyl.
Thanks, Andrew. Not too much to unpack there, and everyone enjoyed what you said, but in particular, I enjoyed looking at your face through it all, Ambassador. So I get the benefit of seeing the look on your face as Andrew was sharing that speech. So I'm looking forward to getting into that. Raymond, over to you.
Yeah, right. Good morning. 大家早上好. I completely agree with what Andy said just now. The two economies are actually intertwined. You think about what happened in the world in the last 20 years, or at least maybe 30 years, since the opening up. Thanks, Greg. You mentioned about 1992 and the early era of the China opening up after Deng Xiaoping's visit to Shenzhen. That's opened the door and confirmed at that time that China continued to commit to reform and be part of the world. And that's a defining moment for globalization, to me, 1992. Since then, that what we have seen is there is a terminology that I put on my book. I published it 5 years ago, 2020. That was a New York Times bestseller. Then nobody bought that book. All the bookstore in the airport closed. That's the big problem. So nobody picked up my book. But then I had a terminology called factory dollar recycling. Basically what happened is that you mentioned about China as a manufacturing powerhouse and the US is technology and financial power as well. But what happened is that these two are the twins with the same cycle. That China every year got a lot of trade surplus, just like Saudi Arabia from the oil export, and then we cycle back to the US economy and support the current account deficit and the trade deficit and the fiscal deficit, because of the US Treasury holdings, now currently $1 trillion US dollar holding. If you look at the TIC number of China, and also you have to add Belgium on top of it because of the Euroclear holdings, also part of the Chinese holding. But anyway, who is subsidized who? I think China has been accused that the government is subsidizing a lot of the manufacturing industry and electric vehicles and so forth. But who is actually subsidizing the US? I think China is subsidizing the US. Why do we have the last 30 years before the Fed hike, a couple of years ago because of the hyperinflation, 10 years US Treasury used to be, you know, when I entered the industry, is probably not close to double digit, but at least 8 to 9% US Treasury 10 years bond yields. It's all the way down to almost zero at one point because of the quantitative easing. Everybody loves US Treasury, so no other choice. And the reason is the US dollar is a global reserve currency. But why do we have the US dollar as a global reserve currency? That's because of 1944, the Bretton Woods, right? At that time, the whole world was short of physical gold, and there's a gold exchange standard that, well, you guys win the World War II, and you're the hero, you know, among all the allies. That's just US dollar as global reserve currency as a substitute for physical gold. At the same time, not a lot of people remember that there was also an organization formed during that time and that year. It's called GATT. And for those who are 20 years of age or below, you may not know what this organization is right now. What is GATT right now? WTO, right? So the whole point of having US dollar as the global reserve currency is because of global trade and globalization. What if this US administration is not supporting US or not supporting globalization, or US taking part of the globalization? There will be a significant implication to the role of US dollar, and also significant implication to how the US government is going to fund their fiscal deficit. So the two economies, usually we are talking about two countries, but who are actually running this factory dollar recycling? US business, China business. It's business running the supply chain, not the countries. But if countries put a tariff or not in between, that would be super disruptive. But luckily, 2 weeks ago, that China is not one of the countries receiving 14th letter from Donald Trump. And now if we want to know about the policy statement of the US, we don't need to go to the State Department website or the White House. You just need to look at the truth, you know, ex-truth. Then we'll know the official statement from the US. But anyway, these 14 letters, on top of the list is Japan. So I have a feeling that this tariff is nothing between US and China because there's so much stakeholder interest, and because of the globalization is so established, it's not easy for one person trying to say that I'm now going to decouple the two countries' economic relationship. No. And I also expect that this tariff will be gone very soon. This type of discussion has been very easy. You know, it's an easy topic for journalists, right? You know, your old shop, Andy. Let's just talk about, whenever they talk about China and US, talk about tariff, 145%, and now down to 55%. The effective tariffs, by my estimation, is only 33%. It's not that high. The three critical issues that you have mentioned, rare earth, the US want to buy rare earths from China. Semiconductors, China want to buy chips from the US. And also some other tariff that may have indirect effect on China export shipment to other countries, via other countries to the US, like Vietnam. And by the way, you know, Vietnam is one of the most Asian economies exposed to the US tariffs the most. 8.7% of the GDP of Vietnam is related to the US final demand, whereas China, just 3%. Just give it up, let it go. Just 3% of China GDP. To me, 88% of the China GDP is domestic. It's all about domestic growth that will drive China development in the futures. And if China is going to transit from a quantitative-based growth to quality-based growth, this will have a significant implication and advantage for New Zealand economy because you guys are producing quality premium product. So the whole development of China is not about whether that is a 5.3% of the GDP. You know, Dashi, you mentioned about in the first half. After that, they announced it on Tuesday before I brought my flight to Auckland. This week, I upgrade the GDP of China to 5.1% for the full year after the number. not because I have to come here and I have to, speak in front of you, so I upgrade the GDP, I'm just a professional economist, sitting in the dealing floor, and we are a fixed income house. And technically speaking, I have to be bearish working in a fixed income house because of, the weaker the growth, the higher the bond price, the bond yield. But be honest, if China is going to transit from this quantitative-based growth, not about how many percentage of the GDP, is about the change in lifestyle, the change in aiming for quality of life. And the previous panel, I love it, mentioned a lot about the change in lifestyle and behavior. And in particular, what I've observed in China, 88% of the GDP comes from the domestic growth, domestic demand rather than the US, and this tariff issue will be gone. And it's not really the core issue between China and the US, because China is an importing country, not an exporting country. If there's an economist telling you that China is an export-oriented country, I think that guy has not been up to date. And that was 30 years ago story. But nowadays, China is an importing story. I don't have to reiterate, this is an $18 trillion economy, US dollar. And there is also 36 trillion Kiwi dollar household deposit sitting in a banking account in China and ready to unlock it, unleash it. And once the consumer sentiments comes back, that will be a big, massive wave of consumption power that waiting for you guys, to tap. Yeah. If you let me to speak continuously, I can talk 24 hours. I'm a professional economist. I have to better stop here now. Right. Back to you, Greg.
Thanks, Raymond. And I'm looking forward to unpacking a bit of that as well. Obviously, we can take questions. So I've got a screen here telling me that if you get onto slido.com, #CBS25, load up some questions and we'll take those in a minute. But thank you both, Raymond and Andrew, for your comments. You're both sort of agreeing with each other. So effectively, Andy, you feel this is another sort of taco moment. Trump always chickens out. You sort of mentioned the 2.5%, 13.5%, maybe it ends up at 20% tariff rate. Is that where you see this going? And if so, what do you think that means?
So taco, for those who don't know, is Trump always chickens out. So that's been the dominant play since we had this episode where Trump said the markets got a bit yippy. As a matter of fact, the markets panicked after Liberation Day on April 2nd. And we saw freakish movements in the capital markets. The dollar, which is supposed to rise on tariffs, actually started falling. Bond rates, which is supposed to fall, started rising. And that's when Trump decided to scrap the whole thing or not scrap the whole thing, delay the whole thing. Since then, yes, the trade has been a taco trade. Nonetheless, two things. First of all, and I'm not sure that Raymond and I agree on this, I think that a tariff rate of 20%, if that's what it's going to be, is really incredibly high. And Raymond is one of Asia's greatest economists, but with respect, nobody knows how this is going to play out because we haven't seen it play out since the 1930s, right? So sure, we haven't had recession in the United States as feared. Sure, inflation is under control. Jobless numbers still looking good. The U.S. economy is still operating at full employment. But don't forget, we haven't seen the full impact. There's been a lot of warehousing and stockpiling. So I wouldn't rule out an inflationary surge. At a high level, this thing can play out in so many different directions. Look, first of all, we can't discount or completely exclude the possibility that Trump isn't stark raving mad and that we could have some good outcomes, right? I mean, we've already seen a few. It's galvanized Germany. It's galvanized Europe. It's entirely possible that Europe could finally get its act together, deliver on the Draghi plan, create a unified market, a unified capital market, start issuing bonds, start investing in entrepreneurialism and compete with the United States and China when it comes to AI. It is equally possible, conceivable, I guess, that it could persuade China to shift its economic model somewhat towards consumption. And I'm sorry, another area where we may have a difference of opinion is I do think that China is an exporting nation. They ran $1 trillion trade surplus last year, for heaven's sake. China, yes, China is a huge exporter. And by the way, it's not only the United States that worries about the Chinese export machine. The developing world is concerned about that too. So that's one conceivable outcome, and maybe it ends up as salutary for the U.S. economy too. Maybe it is all taco, and maybe a combination of cutting taxes, slimming down the government, cutting red tape, may usher in a golden era for the United States. We don't know, okay? Another outcome conceivably could be that the global economy bifurcates right around the United States and China. Countries like New Zealand are caught in the middle, and then you have, a number of swing states, India, Saudi, the Gulf, adeptly playing both sides. I think the jury is out on how this thing could actually go down.
What are your thoughts on that?
This is the only point perhaps that Andy and I disagree is whether China is an exporting country or importing country. So I think most of what you've said that I fully agree with. But I do believe that China is an importing country more than an exporting country, because almost 90% of the economy is domestic demand, and the future is to rebalance the economy relying less on export, but more on domestic consumption, right? This is a policy that's also been the ongoing policy to offset some of the demand fall from the tariff. Be honest, we talk about the gross trade surpluses. You mentioned about, yes, a couple $100 billion a year. But at the same time, that who is actually, all this trade surplus, where does it go? And basically, that will be part of the profit of Apple, because they've got 44% of the margin from producing through Foxconn, in China, in Zhengzhou, in Chengdu, not in Shenzhen anymore. It's too expensive. Longhua is too expensive right now. And by the way, Shenzhen is great. The Shenzhen area has been so developed since 1992. So, and I go there usually during the weekend for massage or whatever. Right now, it's much better services than Hong Kong, and just by subway, then I can get access to it. It's a high-speed train, 15 minutes, from Kowloon, to Futian. So I also got some video, for my banks, and to teach my colleagues how to use the WeChat Pay and to buy Labubu in Pops Max. But anyway, so this time around, the last few days, as I come here and talk to my clients and show the Labubu door in one of my presentations, and then I ask some of the girls, the ladies, that, do you know what this door is? They said it's Lululemon. No, it's Labubu, not Lululemon. But anyway, I'm sidetracking. As an economist, I have to be very entertaining. Every year, that's why Frank asked me to come here every year, because I work in an entertainment industry, not an economist, and also a creative industry that I have a lot of charts that is fascinating. And we add more color into our ANZ chart. By the way, our bank is one of the best research houses in the Southern Hemisphere. So come and do research.anz.com. And I have to do commercial, first. Greg, sorry about that, to subscribe our research. But anyway, back to the topic. It's very fast, it's like talking about the disclaimer. In short, just don't trust economists. What are you saying? What have you said? No. I think the sense of humor, right? No, I think that the problem for this tariff is basically distorting. But we have to remember there are always check and balance. You mentioned about the U.S. Also need to aim for the efficiency. And it doesn't add up. You know, all these items of the Donald Trump policy platform, they don't add up. You know, you have to cut the efficiency, but you also impose a tariff, and then the tariff eventually will lead to some of the inflationary impact to the U.S. consumer. Yes, that might be, but at the same time, this is the one point that I don't agree, because China is also having deflation right now. And the last month's PPI, Producer Price Index, 3.6% negative. And then, yeah, we talk about 5.3% first half growth, that's a real growth, and 5.2% in the second quarter. That's announced on this Tuesday, but the nominal GDP growth is 3.9%, which means from your economic 102, deflator is positive or negative? Negative. Nominal GDP growth below the real GDP growth, right? I know that not all of you study economics. I taught in university, so I'm obsessive to all the cost code, economic 102, macroeconomics, not 101. But anyway, go back to the topic. Is this that deflation is able to curb the inflationary impact to the US? But anyhow, if the US or Trump administration impose a tariff, that will also limit the ability for the Fed to ease. And that will also limit the ability or the capability of the Fed to support the fiscal deficit or the debt issuance of the US government. So as simple as that. They don't add up. So it's got to have a lot of check and balance, and I believe that maybe next year that Trump will say, I win. After the interim election, I win, scrap all the tariff. It could be the case. He has to face the reality. What do you think?
I don't see Mr. Tariff Man, as he describes himself, abandoning tariffs. In spite of all of the predictions that tariffs would lead to recession, inflation, and so on, they haven't. And in fact, they're raking in record amounts of tariff revenue. And in Trump's mind, this is a substitute for taxation. He thinks probably, and actually it may be that the absence of inflation, the absence of negative feedback loops is emboldening him, and he really will come through with the tariffs that he's promised on August 1st and later on China. I would not count out that possibility.
We have the referee here.
Well, that's clear. We all know what's going to happen. Why don't we shift gears just a bit, and we do have some great questions coming through, so I want to leave time for that. Something that the ambassador mentioned in his speech was some of the development that's happening in terms of digital and technology in China. And, I think for a lot of us in the room, we've sort of been schooled on the Magnificent Seven in the United States, and we can reel those off, the Alphabets and the Amazons and the Apples and the Nvidias and the Metas and the Microsofts and Tesla. And I think as I rattle through that list, I say to myself, well, gee, I think Tesla's probably getting a bit of a dusting up at the moment, but surely the others are looking good. And if the world in the next sort of 20 to 30 years is really going to be about digital, about AI, about quantum computing, how do we feel about that in relation to the US and China?
So that's what the 21st century is all to play for. The heart of the US-China competition now is technology. And China's got a great system. And, we all got the socialist, or a lot of people got the socialist economy market wrong. There was this idea that it would collapse under the weight of its own contradictions and under enormous amounts of waste. And look, the waste in the Chinese system is spectacular, but it's also spectacularly coordinated. Actually, the ambassador laid it out very well. It's this whole-of-nation approach. Private, public, centralized R&D, centralized marketing, bottomless supplies of capital, and this incredible winnowing process through dog-eat-dog capitalist competition in the marketplace. And what emerges from this are these apex predators. They are really good. CATL, battery, 5-minute charge, You know, even in the highly protected media space, MySpace, you think about this, the great firewall of China, one of the most censored economies, censored countries in the world, produces a TikTok which has greater insight into the minds of young Americans than Meta, and becomes the first competitor that, you know, Meta has ever had. So they have a system for producing world-beating companies, and we're seeing that now coming through in sector after sector. And what we're also seeing is what amounts to effectively unilateral disarmament on the US side. You think about the one thing that I think the Biden administration got really right on China. And tariffs are not all bad. No, tariffs are mostly bad. Let's say they're 90% bad. They can be good. And the way that they can be good is they can protect industries that you're trying to develop if you identify those industries. And so the Biden administration identified semiconductors for national security reasons, of course, clean tech, batteries, and so on. That was what the Inflation Reduction Act was all about. And you had chips and science for semiconductors and so on. And he was well on his way. When I would go around the world asking businesses, which part of the world are you looking at? What are you interested in? Number one was always the United States, attracted by all of the money going into these technology sectors, the tax breaks, subsidies, and so on and so forth. Then they would talk about India, then they would talk about the Gulf. All of that is now being dismantled. The big, beautiful tax bill eliminates, not just eliminates the subsidies and the incentives, it actually penalizes companies operating in those areas. It adds taxes to these emerging industries, which are absolutely critical, both on the military side and on the civilian side. Elon Musk got it about right when he said this is insanely destructive, and essentially handing the entire landscape over to China. If you want to make your green transition now, and you're in Africa or you're in Latin America, wherever you are in the world, you're going to look to Chinese technology now, and the United States actually may never catch up.
Wow. Comments on that?
Air New Zealand, I look forward to have Chinese CATL batteries to support an electric plane in one day to fly direct from Auckland to Hong Kong and Shanghai, because China has been very good in gluing a piece of battery with whatever things. If you glue a battery with the data transmitter, that is called mobile phone, and you glue a piece of battery with 4 wheels, that becomes electric vehicle, and you glue a piece of battery with 4 wings called drones. So in one day, I hope that that will be some, passenger flight running battery, on the sky, and takes me from Hong Kong to Auckland next time. It'll be very quiet, and power regeneration too. And this is technology progression that China has been doing from mobile phone all the way to drone. And this is also upgraded, combined with the GPS, combined with the data, combined with the very customized personal preference to all the experience that pictures posted, I think in the previous session about visiting BYD or visiting any other, EV showroom. That's fascinating. The Shanghai Auto Show every year is fascinating. All sorts of different ideas and creativities that China's manufacturers have. Is basically, we rule the world. I've ruled the world. And because of AI and robotics, that definitely the futures. Good thing is that also China is having this AI and digital strategy. They call this, Eastern data, Western computing. 东数西算, 东数西算, huh? So which means that I have the demand for high intensity data computing needs, but because of the energy efficiency, I do this in the Western provinces. And there's a lot of infrastructures going on to support this type of, digital infrastructure to support the AI and data center. China has established 8 data center hubs, in the country. And also, in order to support that, that has to be very energy efficient. So the renewable energy share of the current mix is already coming to 20%. 6 years earlier than the goal that previously set under the energy or renewable energy or clean energy target. So these have been happening very fast, quickly. So in order for example, New Zealand to adopt the dynamics of the Chinese market, we really have to think about the China speed. That maybe we talk about an annual planning, but even within 1 year, the China business cycle and the market cycle has changed a lot, maybe 2 or 3 cycles already. So the trend and all this, I do believe that the consumption will be the future of China, supported by the technology improvement, and also, with the US or without the US, China is going to do that anyway. This is a national development blueprint, for the future in order to double the GDP, but in 15 years by 2035 from year 2020.
Thank you. We've got about 10 minutes left. Let's sort of pivot to some of the questions that are on the screen, and not surprisingly, it's going to be around, so what does it mean to navigate this if you are a New Zealand company? How are you going to do this tension between US and China? What's your advice around that?
Wow. It's very difficult and super complicated. I was sort of thinking, when I was in China, I was actually on the board of Beachheads, and public-private partnership, watching New Zealand startups and companies coming into China. Very difficult navigating China if you're a small New Zealand company. One of the trends that I see is companies now teaming up with Chinese companies. Let's acknowledge that in many areas, Chinese companies have the lead. So if you look at what's happening in China now on the auto side, the Germans, who used to own the market, are now losing the market in combustion engines, but coming back into China and setting up JVs with Chinese companies, because Chinese companies now dominate the EV battery space, EVs generally. I think it requires a certain humility, and I think in some ways it requires playing China at its own game. So inviting Chinese tech players into this economy, working with Chinese tech companies, and then moving out with Chinese companies. They go everywhere. I mean, this sort of flying geese formation, leaving China, going down to Southeast Asia. The fastest growing trading corridors in the world today are between countries of the global south. So Southeast Asia, the Gulf, India, China, and so on. And Chinese companies lead the way. My recommendation to New Zealand companies, take it or leave it, is that they should be exploring collaborative tech opportunities with Chinese companies rather than thinking in terms of going it alone as tech players in the Chinese market.
Thank you. Raymond, we've got a question here around what do you think is going to drive Chinese consumer confidence to spur domestic consumption?
Thank you, Greg. You're not asking me to answer the question of advising the New Zealand business. This is a right decision because I don't know how to do business. You don't want to ask economists to advise on doing business. But on consumer confidence, I think that I do have some thought on that. Basically, the Chinese consumption is cyclically driven. The last few years that we have seen, the downturn of the property market is the number one and the key issue that drags the consumer spending and the sentiment. Now, we definitely need to see a recovery of the property market in order to have a sustainable recovery of consumer spending and sentiment because of the wealth effect, right? Think about that. The latest number last month is the property price in China still dropping on a month-on-month basis. So has not stopped. That I do believe that our forecast is at least another 18 months, at least maybe 24 months for the contraction of the Chinese property market to touch zero again and return positive. Now that sounds bad, but that's the national strategy to change the country from a property-led economy to a tech and renewable energy-led economy and tech-led economy, so the technology-driven economy. So that is a must to go through this transition. Now, during this transition, the government started to support the property market. There's no more restriction, basically, except for certain districts in the top tier fours, the first tier city, you know, Beishang, Guangshen, and for outsider could not buy the property. Otherwise, you know, it's basically relaxed. And at the same time, there's a lot of subsidies. And this year that the central government earmarked 500 billion RMB to support the consumer spending, and that was very effective in May. The May retail sales is already 6% increase. Now, of course, last month, in June, that the number down to below 5% because they front load some of the spending in May because of the holiday, and the Liu Yao Ba, the 18th of June, subsidy has been front-loaded as used by Pinduoduo and Taobao, you know, earlier, Tmall as well. So, but anyway, so in between, before the the property market rebound, that we definitely need some more stimulus to support the ongoing consumer spending, and for the overall full improvement of consumer sentiment, we need to have the property market rebound.
Good. I'm going to throw another one at you here. I think it's a really interesting question. Opportunities for New Zealand high-tech firms. So not just sort of agriculture, primary products, but, you know, if you're into space and into deep tech, do you see opportunities for New Zealand companies to operate in China there, and to pick up Andy's point, possibly through a partnership?
Yeah, I think so. On this point, again, it seems like a business advisory. You know, I asked me to advise, you know, any tech company to work in the China market. If I know it, then I'm not working for ANZ Bank. I will make a lot more money. You know, because we all love to support our consumer. But I just think that on this point, it's all about collaboration. Technology. You think about that, why Silicon Valley is so successful, because they group everybody together, you know, and lock them together in San Francisco and San Jose and all together, and to crunch some of the new ideas and creativity in tech, and also other form of applications. So in this sense, that New Zealand tech sector and the Chinese tech sector definitely need to work together, you know, on an equal basis, and to exchange and collaboration. That's how human creativity comes. It's for the people interaction. That's much more important than anything else. And other opportunity, because of the Chinese economic landscape, what I'm seeing, it may be a very unique ideas that you may not find from other economists, you know, in town, is that now China become a low-yielding country. In fact, the cost of funding is so low, and they're looking for outside opportunity and yield chasing. You know, the 10-year bond yield in China is 1.5% or 160 sometimes, but then, you know, outside world here at the 10-year New Zealand government bonds have more than 4%, 4.5% sometimes. So you can think about that. The yield motive or yield chasing motive will drive some of the capital or venture capitalists to support other different type of projects, especially in the tech and digital project. These are the things that I think the business and the tech business can tap. The Chinese export of capital or financial capital, even for the infrastructure projects here, will be a biggest opportunity I see, you know, from the financial market perspective. China is ready to help because of the cost of funding is so low, and also Hong Kong dollar as well. The high balls overnight is now down to almost 0%. Even with the Hong Kong dollar peg is once in a lifetime opportunities that you can tap a very cheap cost of capital that is so eager to support the infrastructure and technology development.
Thank you. Andrew, just very quickly, any final comments from you? Any final thoughts?
Give me a clue, give me an area.
Just anything as you've listened to the conversation here. Is there anything that you'd like to leave the audience with that you go, gee, that's just one thought that I'd just like to leave them with?
Yeah, so I think that the ambassador said it very well. The Chinese economy is growing. The Chinese economy is not going away. And as a matter of fact, I think that the the final outcome of the Trump tariffs may well be to encourage companies to stay in China. Why would they leave and risk higher tariffs elsewhere in the market? The companies that we dealt with, by the way, I've left Brunswick Group now, but when I was at the Brunswick Group, very few people, very few companies are leaving China. The bigger play and the more interesting play was digging in deeper, becoming Chinese in China for China, indigenizing technology, indigenizing your talent base, buying local brands, localizing your brands, retooling your capital structure to get more capital out of China, potentially even listing there. And I think the ultimate outcome is going to be of this trade war may well be strengthening the position of China in its bid to attract global investment. And I think New Zealand should be part of that trend.
Thank you. Wise words. I'm sure that you can join me in thanking both Andrew and Raymond for this very good session. So thank you both. Really appreciate it.